Welcome to the New Mexico Suncast. I'm with my friend Brian Cochran. Brian, welcome.
Yeah, glad to be here.
It's good to see you. Brian is a certified financial planner, and he's the president and CEO of John Moore Associates. Brian, I've gotten to know you pretty well over the last, 6 years, you think?
Yeah, it's been a while now.
Yeah, and I want to have our viewers know a little bit about you. I know your two boys are high school basketball players and doing pretty well. You're married to Emily. Mm-hmm. I have an Emily, which is why I can remember that. I don't know your wife well, but I sure do enjoy watching her at basketball games. She's pretty enthusiastic.
Yes, that's a good word, enthusiastic. The referees might think she has a different title for that. But, I got a great family. Really proud of what the boys are doing with their academics and their athletics. So that's been fun as they're getting older. Sophomore and junior this year, so they're getting big. Yeah.
Well, when you say big, I mean, you're talking 6'5", 6'3" kind of thing.
Yeah,
so and you're like 6'6", 6'7".
Yeah, I'm about 6'5".
6'5", okay.
Yeah.
Well, the reason I made you bigger is because you play a little bigger. You got those hops.
I appreciate that.
I never had that. So people thought I was 6'1" and I was 6'7".
Yeah, and that's always our challenge when we've had conversations in the past. It's like, we gotta stay off the basketball because we get going on that trend.
That's right.
And we got 2-hour conversation just on hoops because it's a passion
really
for both of us. It's been a lot of fun.
Where are you from?
I grew up in the Northwest, a small town in Southwest Washington State, and ended up in New Mexico because my wife and I met when I was at school in Southern California. So a lot of Northwest kids try to find some sunshine for their college experience. So I went to California Lutheran University, which is just outside of maybe about an hour north of LA, and met Emily there, and her family had been here in Albuquerque for quite a while at that point, and so we came back and made our lives here.
Well, John Moore Associates is an independent registered investment advisor. And tell us a little bit about your company and what you do. And then that's going to lead us right into, we're going to be talking about the big, beautiful bill. Of course, that's created controversy on both sides of the political aisle. But as citizens, we all kind of want to know how that's going to affect us personally, and you're going to give us a lot of that information today.
Yeah, absolutely. So a little bit about our firm. So we started in 1997. Our founders, John and Connie Moore, launched the firm in Albuquerque, and have had a lot of success since then. So I became the successor, the backup owner, if you will, to John and Connie, and we finished that transition in 2022. It's been a really good road. So we serve about 650 families really across the country, and we manage just over $1 billion for those families, so a significant stewardship responsibility.
And you have offices in Albuquerque and in Phoenix.
Exactly, yes. We have a Scottsdale office, and our main location is still here in New Mexico. And being an independent registered investment advisor, what that means is we're not owned or guided by a bank or an insurance company, so we can really do what we feel is in our client's best interest and gives us a lot of latitude to choose the investment solutions and financial planning strategies that we feel are best, and also create our own values. We really focus on building financial plans based on biblical principles. It's kind of what makes us unique in our space, and have really become engaged in an organization called Kingdom Advisors through that work. So integrating faith and finances. And the beauty of that is not all of our clients are people of faith, but they all benefit from those principles, I believe. So it really helps us stay on the right track when we give our advice and be consistent in the values and the principles that we live by.
How'd you get interested in being a financial advisor? Did you join the firm at John Moore?
So I actually started with another company. So I actually studied education. I was intended to be a teacher and a coach when I was in college, as Emily did too. So we were both in the education field, and actually taught for about 1.5 years out of college. And then was recruited into the industry by a gentleman who was in the Board of Regents at our college, and I knew well from some of the work I did there, and ended up coming to New Mexico partly to start a career in financial services with a great national organization. So I was there for about 7 years, and then John Moore and I connected. We actually knew each other from church and some other circles, and knew his family well, and from there connected to John Moore, became his successor, and that was in 2013 I joined the firm.
Brian, I should mention, you already alluded to the fact that you went to work at John Moore and became very good friends mentor John Moore was to you, and you ended up being the succession owner. But you also wrote a book with him about this, and I think that might be valuable for a lot of our viewers. That's called In Succession. And
exactly.
how is that available?
You can buy it on Amazon. It was a really fun book to write. So it's actually pretty bite-sized books. They're meant to be an easy read for a predecessor and a successor. And basically, we created the same narrative, the same principles across each chapter of 2 books, but one is designed to be read by the predecessor and one by the successor, and it's meant to be read side by side, and each chapter ends with questions to ask yourself for your role, and then questions to inspire conversation between the predecessor and successor. And it's topics such as values and communication and expectations, trying to guide these companies that might be in similar succession plans to have maybe a higher chance of success, because it's difficult to pass on leadership of an organization, especially when it's an owner-led or a founder-led company like John Moore Associates was when we started our plan. So it's a lot of fun to put that together.
Do you find New Mexico has a lot of small businesses that might be thinking about that, even if it's a dad passing on something to family members? Good to have a plan.
Yeah, and we speak to that, the whole family succession, and because sometimes what happens is you have father-son or father-daughter or daughter-son, but the values really aren't the same. So people assume that their child will be their successor, but if you actually do a values exercise, sometimes you find out that this may not be the right succession plan. Sort of the default is not the best. But New Mexico, lots of small businesses. And then what's happening generationally with the boomers moving into retirement age, and now I'm an elder millennial myself, but Gen X and millennials coming into leadership age, if you will. They've matured in their industries. There's a lot of handoffs happening right now. It's a big time transition period because of the generational sort of dynamics that are happening, and it's part of the great wealth transfer of, some people say 80 to 100 trillion dollars will pass over the next couple decades. Part of that is business ownership and leadership.
And so this succession plan is very important. Again, you can go to johnmoore.com. You can click on the book. You can buy it on Amazon. 2 books?
Yeah, 2 books. We have the In Succession book, which is great for folks who are in leadership roles and handing off, and that could be a business ownership. It could be also applicable to nonprofit leadership or church leadership. That's a really a great resource for all sorts of succession, even maybe like coaching leadership, things like that. So hopefully lots of application there. And then we also built a book off of some teaching that John Moore had done in the past, where it's more just kind of your financial foundations. So a lot of fun there. And then we do a lot of great content. We call it our Insights page. All of our various planners contribute to that, and that includes videos, blogs. We just launched our YouTube channel. So there's a lot of content there that is not salesy at all. It's very much education and information that's designed to be valuable for the families we already serve, but also just general information that's hopefully valuable to the public.
Yeah, I've watched a few of the webinars, and again, that's a good transition right into talking about what we're going to talk about today. We're going to be talking about the big, beautiful bill. Everybody's heard about it. The people on the left are criticizing Donald Trump, and Donald Trump's team is criticizing everybody on the left. So we're not gonna go into the weeds today about all of that. The big, beautiful bill has been passed. It's been accepted. It's going to start taking effect, and it's going to affect all of us as citizens in various ways. So that's going to be the primary focus of what we talk about today. But I've got to start with a couple things that I know you'll keep us from going too far political, but you hear the criticisms that the big, beautiful bill is going to really create additional deficit, I think $4 billion over the next 10 years. Of course, Donald Trump can't be the president for the next 10 years, so I'm not sure how that math works out. Right. But tell us a little bit, what is the deficit, and who does America owe this money to?
Yeah, so for terminology purposes, the deficit is the annual shortfall that the government has where they're spending more than they're taking in. And then the debt is the total aggregate balance of all those deficits combined, basically. So if you think of it from a household perspective, it would be like the deficit would be the amount I'm charging on my credit card that I can't pay off every month, and then the debt would be the total balance of everything I owe. So the total debt is well over 36 trillion at this point, and you said 4 billion. actually. It's $4 trillion
Is it?
of additional debt added over the next 10 years. So these are big numbers. If you're not sure, try to write $1 trillion just on a piece of paper sometime and count the zeros. I mean, it's really quite amazing, the numbers and the scale we're talking about. So the reason the One Big Beautiful Bill Act, which is the official name, the One Big Beautiful Bill Act, the reason it was so controversial is because there were spending cuts associated with programs that the Democrats would like to keep. There were tax breaks either maintained from the 2017 tax reform or added to in the One Big Beautiful Bill that the Democrats didn't love. But then also there were people on the right that weren't happy because of the number you mentioned, the $4 trillion of additional debt that will be added based on Congressional Budget Office projections. So it was a little bit, there was something in there to make everybody upset, which is why it was difficult to kind of get over the finish line. But I think the key that I want to talk about today, and I think that triggered our conversation, is there's a lot of provisions in here that are meaningful for the average American that were lost because people on the left were so focused on, oh, this is all just a big handout for billionaires, and people on the right were saying, oh, this is just a deficit exploding bill. And in between, there's actually what we have found to be some fairly meaningful tax savings for whether you're a couple with two working incomes, two working spouses with average incomes, or if you're a retiree. There's a lot of benefits here that I think will actually move the needle for some households when it comes to tax savings that could spur economic incentives and development where people have more money in their pocket to spend on goods and services.
I'm going to encourage our viewers now. As Brian is talking today, Brian's the kind of guy that is going to encourage you, no matter how much money you make, to take the first portion of that and give to help other people. And then he's going to ask you to take the second little bit and save it. So you believe that people can give and they can invest no matter how much money they're making?
I think so. And I've seen that proven out with families and individuals I've served who make much less than anyone you think would be able to live on, and yet they are generous. They are building up financial security through their savings. And I've seen people get to $1 million plus net worth who have never made more than $60,000 a year. So it's possible. It just takes discipline and time. And so that's the key. And that's where I get encouraged by what I see in this bill is I think there are incentives and rewards for working class people that will maybe help them get over the hump financially if they are wise in their stewardship of what they've earned.
Let's start going through some of those. A lot of new deductions and credits for people.
Yeah, and I've got my notes here because there's so many numbers and the timelines are different. So a couple things I'd pay attention to as I'm going through this is some of these things take effect immediately, and some of them don't take effect till the next year or two. So listen for the timelines, but also listen for the thresholds where there are phase outs. So when I say the word phase out, what that means, Jim, is that if you earn over a certain limit, you lose access to these special provisions. And this is where I get a little frustrated from the political point of view that folks on the left were saying, well, this is all just a tax break for billionaires, because when I run the numbers and I have tax software I can use to run projections of how the new bill might impact different households I serve, the high-income households, the extremely high-income households, really aren't getting any of the benefits from this bill aside from maintaining the current tax rates, because so many of these incentives we're about to go through phase out. Therefore, it's only the middle class and upper middle class folks and below that will receive these benefits. So keep an ear out for those phase outs, because you're going to see many of these provisions do phase out at certain incomes. So the first one that was a promise that Trump made during the campaign, actually Kamala Harris picked up in her campaign, was no tax on tips. So the idea that some income earned from tips would not be subject to federal income tax. And the way that played out is starting this year in 2025 and going through 2028, the first $25,000 of tips you earn will not be subject to income tax. Wow. So you think of your servers, and tips are common now, right? We hear a lot of people talk about this. There's places where maybe you didn't get tips in the past, and now you get tips. There is some special language in the law that makes it so you can't just say, I'm going to start making all my money on tips. So it has to be roles that traditionally receive tip income, and there'll be a list of those roles provided by the IRS as we get more regulations. But I would note this is that phase out. If you're a single person, you make over $150,000 a year, you phase out of those exemptions on your tip income. Or if you're a married couple making $300,000. So if, let's say I make over $300,000 a year, and my wife is working part-time as a server at a restaurant, my income can make her phase out of that tip benefit. So households that have high income, again, won't get this benefit. So this is really targeted towards working class folks making tips.
And I'm seeing people all over New Mexico are
Yeah.
going to be benefiting from this.
Yeah.
Do you think people, because of the noise politically, actually understand that?
I think it was missed. Certainly, if you read all the articles, if there was a CNN post on their website or Fox News or something like that, we tend to just read the headlines. So if you read the headlines, it says One Big Beautiful Bill Act adds $4 trillion of debt, or the One Big Beautiful Bill Act is a huge tax break for billionaires. Well, if you didn't go through and actually read all the provisions, you might have missed that, oh, actually, I'm not a billionaire, but this is going to help me in my household because that tip income I earn is no longer going to be taxed, and that's great. So a good example of where these things got lost, I think, in the headlines and the narratives. Yeah. Another one that's relevant for the working class families is no tax on overtime. I like to talk up the people that come to my house to take care of plumbing and electrical issues that I don't have time or skill to do. And all those guys are working overtime because their roles are in such demand. We don't have enough plumbers and electricians.
They're on call all the time.
They're making good money, and part of it is overtime wages. So this is also 2025 through 2028, just like the tips. It's a $12,500 deduction, or up to $25,000 if you're married, on your overtime wages. So if you're making overtime income, this could be a good contributor. And this is the same phase out as we talked about for the tip income. $150,000 if you're single, $300,000 for those married couples. So a nice way to earn a little extra income from your overtime and not have it subject to tax.
Yes, I love it.
Yeah.
I love the next one.
Yeah.
Because I'm a senior.
So if you're 65 and older, you might like this one. So the idea here is, even if you're not working right now, maybe you're in retirement age, well, how do we give them a little extra boost through tax savings? So starting in 2025, you get a $6,000 extra deduction, per person in your household that's over 65. So if you're a married couple, this could be $12,000 of income reduction. Again, phase outs. Now we have lower phase outs on this one, so pay attention to these numbers. Is $75,000 for single. So if your gross income is $75,000 or over, you'll start to phase out of this, and $150,000 for married couples.
Brian, I want to have you clarify something. So a lot of seniors, not all, but a lot of them, have savings. Taking money out of your savings is not income. So that's not going to be but the interest you're earning through your investment accounts might disqualify you.
The exception I would add to that, Jim, is if you take money out of a pre-tax account like a 401k, 403b, traditional IRA, that is recognized as ordinary income and would increase. So one of the tax planning things you want to consider on this is, okay, I want to get my full benefit of this deduction, but to do so, I might want to be thoughtful about how I generate my income in retirement. Is it coming from a Roth IRA, a traditional IRA, or just a savings account?
And is this part of the planning that you provide people?
Exactly, and we use some robust tax software to guide this, and then we coordinate with the tax advisors that our clients have enlisted to make sure that we're all on the same page. This provision, by the way, is to try to fulfill the promise that Donald Trump had on the campaign trail of no tax on Social Security. They did not pass it as a just total exemption of Social Security, as waiving that from your income. But one thing I think is interesting is in New Mexico, there is no tax on your Social Security for state income tax purposes if your income is below 150. That's the same threshold where we start to lose this exemption from income, or this deduction, I should say. So it's really important if you're a retiree. If you can keep your gross income below $150,000, then you're not only going to avoid Social Security taxation for state income tax purposes, but also you're going to earn the full benefit of this deduction we talked about. That's $6,000 for individual, $12,000 for couples. So paying attention to how you generate your income was always important, but it's even more important now with the fairly recent addition of no tax on Social Security in New Mexico, but also now this deduction.
I'm always interested about car loans.
Mm-hmm.
I mean, everybody I know under 55 years old has a car loan.
Yeah.
And some of these people, married couples, have car loans that are $1,500, $1,600 a month. It's crazy. That's a house payment, right? Or at least it was when
At
I
some
was
point
younger.
it was. Yeah.
So is car loan interest deductible now?
It is now under the new provision with certain rules and exceptions, so you have to kind of pay attention to the small print here. So it's basically starting in 2025, you can deduct up to $10,000 of interest. Here's what's important on that is it has to be a new vehicle, and where it's manufactured matters. But the beauty of this is, you and I may have deducted mortgage interest in the past, and you have to itemize your deductions to get the benefit of a mortgage deduction. To get the car loan interest, you do not have to itemize. So you can take the standard deduction. So let's use an example now of someone who's 67, let's say a married couple, they're both 67, and they've got a car loan. They go buy a new car and take a loan. They can get a $12,000 deduction because they're over 65.
Wow.
And if their car loan is $5,000 of interest this year, they can deduct that and still take a standard deduction of over $30,000. So all these things are reducing their taxable income and reducing their tax liabilities. But the new one there with the car loan is meaningful. I have a little bit of a bias against this one, if I could share my personal preference, because I don't like car loan debt. I don't like anything that incentivizes car loan debt. I understand that.
While you're talking, though, I think there's people that are car dealers or car salesmen that are watching, and
Sorry, guys.
they love the bill, right?
Yeah.
So I want people to compare and contrast. I mean, there's pros and cons.
Yeah, and I acknowledge that some folks, the only way they're going to get a new reliable car is to take a loan. So I empathize with that. I've had car loans in the past, but I like to think of these things as incentives and benefits. And I don't like the idea of incentivizing people to take a debt on what will be a depreciating asset. But this is another thing for the average working class person who has to use a loan to buy a car. Great, we're giving them a little extra, deduction here that they don't have to itemize to take, that they might be able to use. So in that way, it's going to help. And again, this is another thing. There's no income phase out on this, but I also don't serve many couples that make $1 million a year and have car loans.
Yes.
So folks who can buy car cash, they're not getting a benefit from this. But folks who need a loan to get a reliable new vehicle, they're going to benefit.
I haven't heard one thing you've said yet that benefits the billionaires.
No, none of this has yet. Yeah, I mean, there are provisions in the. Don't
Yes.
get me wrong. There are parts of the One Big Beautiful Bill that do favor higher income, higher net worth folks, but these are great provisions that do nothing for someone who makes high income.
Child tax credits are kind of confusing to me. Explain how this bill addresses
Yeah, so this is important because it's a tax credit, not a tax deduction. So to clarify those terms, a tax deduction is something that reduces how much of your income is subject to tax. A tax credit is a dollar for dollar reduction in your tax liability. So if I have a choice between something that's a $2,000 tax deduction and a $2,000 tax credit, the credit is way more valuable. So child tax credits are a big deal. We already have child tax credits, which is basically a reduction of your tax you owe for each child that's in your household if you're below the income thresholds. But what they did is they bumped that up slightly. It was $2,000 per child. Now you're looking at $2,200 per child, and there are income phase outs. So for single folks, it's $200,000 of income. You start to lose your child tax credit. It starts to phase out, and $400,000 for married couples. So again, above the middle class for sure.
Sure. Yeah, I find that interesting. Going to college, going to any kind of school, vocational school, training to be a mechanic, whatever it might be. There's now some credits for scholarships.
So this is donations you would make to a scholarship fund, and that starts in 2027. I don't know why they did that. So many of these things start this year or next, but in 2027 you can give up to $1,700 as a tax credit to a scholarship fund. So when you have something like this, it becomes almost like a no-brainer to take it, because I have a choice basically. Is I can either give $1,700 to pay my income tax, or I can give $1,700 to support a a qualified scholarship credit fund for my alma mater, for my old college, that becomes sort of a no-brainer. So again, that's 2027. And I think a lot of universities will do a good job promoting this and reminding you of it when that date comes, saying, hey, just so you know, if you want to support our scholarship fund, kind of an odd number, 1,700 seems sort of random. But it's a nice little benefit to get a direct credit for that donation.
I love it. Charitable giving, again, I mentioned at the onset of our interview, that's something that you really emphasize to people as part of their financial plan is, really supporting other people and taking care of people that in need. Talk to us about the charitable giving and deductions.
Yeah, generosity is one of our 4 values as a firm. So we try to be generous as an organization, and then we try to inspire our clients to be generous. So we try to stay on top of charitable giving rules. So a couple that are noteworthy here. The first, and this one I really struggle to explain, but it's another one that only hurts the higher income folks, and there's a giving limit now where you have to, the first 0.5% of your gross income that you donate to charity is not deductible. Okay. So if I make $100,000 a year, that means 1% of my income is $1,000. So the first $500 of my donations I make to charity are not deductible. Okay. So I have to get over that hump. Now, where this hurts a high income person is if I make $5 million a year, I have to give quite a bit to start getting over the hump and getting a deduction for my donations. So again, this is where there's little things woven throughout this bill that really don't help the high income folks. So that giving limit on the low side is important. How much do I have to give to start getting an itemized deduction? But what's beautiful is they did keep the 60% limit for deductible gifts, meaning that if I make a huge donation in a given year, there's a limit. If I make a cash donation, there's a limit. I can only deduct, historically, the last couple of years, 60% of my income. So if I make $100,000 a year, I can only take a deduction of $60,000 for cash donations. They've maintained that. There was a time where that was lower. It was down at 50%. If you're going to give assets like stocks or real estate, there's a 30% limit on that. But it's nice to keep that 60% higher limit. Some people are thinking, who gives 60% of their income? I serve families who push that limit each year. So it's a good thing to understand that we're going to keep that higher limit. So got to get over 0.5% to be able to start a deduction, and then our speed limit, if you will, is 60%. That's the highest we can go and deduct. If you give more than that in a given year, it carries forward for up to 5 years, but you can't take it that tax year.
Why do people that are so generous thrive both mentally, spiritually, and otherwise? Is it just an amazing thing to be able to help other people?
Yeah, I think it's, well, from a biblical perspective, which is where our worldview is, it's said that it's better to give than receive. You actually get this amazing emotional reward, and we've seen that with the families we serve, who can be sometimes what I would say is radically generous, and it's amazing to watch them. And then, walking alongside them, I get a little extra bit of that emotional benefit, and it's great to do that. I think it's just the acknowledgement that we're sharing with others. When I give, I am acknowledging that someone else's needs are as important as my own. I am humbling myself. I get to see those dollars used for great purposes that are maybe better than what I would have done with them. There's a lot of benefits there. So the fact that in the U.S. tax code we reward that, not all countries do that, by the way. There's a lot of countries, Western countries, that don't give any benefit on their on taxes for sharing what you have.
Yeah.
And we serve clients that are believers and non-believers that are amazingly generous and inspirational. They inspire me to be more generous and challenge me in my own giving, because I see what they do. I see the sacrifices they make in their lifestyle so they can give a lot over here. And it's incredible. And so I love that we're keeping some of those rewards in place.
The reason I bring that up for our viewers is I think there's a lot of bad news out there. Mm-hmm. And this is really good news. People don't realize how many giving, generous people there are in the world.
Yeah, I mean, it's incredible. And I could spend 2 hours sharing stories that would blow your mind in terms of how much people are giving each year, or when there's a big event that happens in their lives and they have the ability to give more, how they just just share so willingly without hesitation. It's really great.
I love that. Is this a new thing, a non-itemizer charitable deduction?
Yeah, so it's not quite new because during COVID, there were bills passed to sort of give some accommodations during that difficult economic time. One of the things they allowed at that time, and you and I talked about it on the radio, I believe, at that time, was that they were allowing a non-itemized charitable deduction. At the time, it was about $600, I think was the limit. So now, starting next year, so this is a 2026 provision, even if you don't itemize your deductions, you can deduct $1,000 for singles or $2,000 for married couples of charitable gifts, cash gifts only. So it can't be stock or real estate. But this is a great little incentive for those maybe lower to middle class folks who probably won't itemize, that they can still get a little bit of a tax benefit from their donations that they're already making or would consider making for the tax benefit. What I love about this, Jim, is that when the 2017 tax bill passed, that was during the original Trump term, it was sometimes called the Trump tax cuts, but it was called the Tax Cuts and Jobs Act. That was in 2017. They increased the standard deduction. Mm-hmm. So, the number of people that itemized went from about 30% of all tax filers down to about 10.
Wow.
So for 90% of folks who are not itemizing, this is a great incentive to give or a benefit for the giving they're already doing that I love to see.
Has the itemized deduction cap changed?
It's been kept at the higher levels that we got from the Tax Cuts and Jobs Act, and during the One Big Beautiful Bill, they actually ticked it up a little bit.
Okay.
So that's one of the benefits that's going to hit many households. It'll be a nice surprise is that their standard deduction is going to be a little bit higher.
Yeah, it's kind of interesting when you go through, if you're using any of the TurboTax or H&R Block or any of those packages, you can go in and you can list all your deductions that you want to itemize, but then a lot of times the standard deduction is quite a bit more.
Oh, it's huge.
But it's neat that this is now going to be available for 2026. What's the SALT deduction expansion?
Yeah. SALT stands for state and local taxes. So if you're in New Mexico, that state and local tax comes from two places, your property taxes and your state income tax that you pay on your income. So this was another part of the previous tax reform, the 2017 reform, that was quite controversial and really hurt people in high income tax states. So you're thinking your California's, New York's, Illinois, these states that have high income tax. In the past, there was no limit to how much state and local tax you could deduct. So if you were in California paying $200,000 of state income tax, you could deduct that against your federal tax. Now, if you think about that, that's not really fair in a way because you're getting a relief on your federal tax just because you live in a high tax state, whereas someone in Texas or Nevada or Washington that pays no state income tax may not have such a tax burden, so they're paying a higher federal tax on the same income. So it created some imbalances. So the Tax Cuts and Jobs Act moved it down to a $10,000 limit. The One Big Beautiful Bill bumped that limit up to $40,000. So now you can deduct up to $40,000 starting here in 2025. I would note there is a phase out on this too. So it's a higher phase out. So if you make $500,000 or more, you will start to see that $40,000 limit on your state and local taxes phase down. So I looked at this, for example, for a client who has $800,000 of joint income as a household. Hardworking couple, they both hustle, really make good incomes. So they're completely losing that $40,000. So the most you'll be able to deduct is $10,000 if you have over $600,000 of income.
Gotcha.
So this is another one where, that's a handout, more state and local tax deductions for high income earners. Well, not really. If you're really high income, you're going to see that go down. So so it's a nice one for that kind of upper middle class is the sweet spot here where you are below $500,000 of income, but you're paying a lot of state and local taxes. You could get a $40,000 deduction on that state and local tax now instead of $10,000.
Everything that you've talked about today is benefiting lower and middle class people. Yep. Not really designed to benefit high income earners. You told me something several years ago, talking about a progressive tax system. You said a very small percentage of wealthy Americans in the country are paying the majority of taxes in our country Do you recall that?
Yeah, and I try to think of the numbers right now, but I think it's the top 10% pay somewhere around 80% of the income
Yeah.
tax, something like that. And I could be happy to look that up on the fly here. But,
Again, the high wage earners, the very wealthy people, the billionaires, they're paying 80% of the taxes in this country.
and I would note they do earn a disproportionate amount of the income as well.
Sure.
But they pay a higher percentage of the income tax than they earn a percentage of the income. And the other thing I would note is half of all tax filers in the U.S. pay no federal income tax. So that's a very progressive system where
But
you go
that's
from
not
zero
all the rich
to all
people.
up. So yeah. Oh no.
I mean, you hear the rich people are never paying taxes. I don't think that's true.
No, and we do have some favorable tax rates that incentivize asset ownership. For example, capital gains tax rates can be very favorable. But even then, if you have higher income, those capital gain rates go up. So there's a lot of provisions that create a very progressive tax code. And I think what people misunderstand sometimes is when they want a higher tax system and they want significant government benefits, such as really robust health care benefits, like you see in some Western countries in Europe. What they don't realize is the middle class families, the middle class income earners in those countries are paying far more of their income towards taxes than we do in the U.S. If you're a middle class family in the U.S., you don't pay a very high tax burden as a percentage of your income. These other countries, they're paying, 20, 30, 40% of their income as middle class families, whereas I serve a lot of families that are working class, modest income households with maybe 2-3 kids, and they pay almost no federal income tax. Wow. So we still favor those families pretty well here. If we wanted those more robust benefits, we couldn't just tax the rich. We already do that pretty well. We could increase those taxes, certainly, but you would definitely need to see a higher tax on those middle class to upper middle class families in order to truly sustain the cost of those benefits. Yeah.
You can slap me if I took us too far into the political weeds, but I think
Yeah.
people we
It's
don't know
reality.
we don't know where to find the answers to this,
Yeah.
Brian. I want to point out again, Brian, President, CEO, and a certified financial planner with John Moore Associates, johnmoore.com. They have an Insights tab that gives you amazing information for free. A lot of times you even post interviews and different things, webinars on different subjects. And, we're spending an hour today going through very rapidly all over this. But I want people to know you're a resource. And you have a team of people. You have men and women on your team as an investment advisors that can help people. If somebody's interested in giving you a call, they can do that. Is it okay if I point out your phone number and all that kind of information?
Sure. Feel free to.
Okay. Well, you want to go to johnmoore.com, and the phone number for John Moore is 505-881-5100. You can reach out via the web is there an email address if they want general information?
Info@johnmoore.com. Pretty easy.
Info@johnmoore.com. That's good stuff. Let's talk now about estate and gift tax. Again, you alluded to some old people like me. We're coming to that point where we're trying to figure out, what are we going to give our kids and leave for our kids. Talk to us about estate and gift taxes.
Yeah, and this would be the area that does benefit those high, maybe not high income, but high net worth families. So when you talk about estate tax, the biggest variable that we see there a lot is not so much the rate that we pay on an estate transfer from one generation to the next, but how much estate do we allow to transfer from one generation to the next without tax? That's called the estate tax exemption. So this has been all over the place during my career. So if you look in the late 90s, the estate exemption, the amount that, like if I was your son, Jim, you should be so lucky. If I was your son and you wanted to pass on a legacy to me, the first $600,000 I would receive in the 90s would come over without estate tax. But anything beyond that could be subject to a estate tax, which is a pretty high rate. Usually it starts at about 40%.
Wow.
So imagine, if you had a $1.6 million estate, I got the first 0.6 of the million of the estate coming to me, and then the other million could be taxed at 40%. Ouch.
Excellent.
That number was bumped up over the years. It sat around $2 million for several years. Then it kind of settled in around $5 million and then jumped up. The Tax Cuts and Jobs Act moved it higher and then had a sunset for the end of 2025, where it would bump up with inflation and then fall way back to about $7 million. So the One Big Beautiful Bill has set that estate tax exemption at $15 million per person. mean that a married couple can transfer $30 million to the next generation without tax. So that's one part that certainly does benefit high-income households. Now, philosophically, you could argue, is estate tax fair? Is that really a good way to get tax? There's a lot of debate there. So that's one that provides a lot of certainty. We work with a lot of high net worth families. Just having some clarity on this is nice because there was this threat that was going to sunset and drop down much lower, and that create a lot of uncertainty and potential risk to their estate. So this is something where you can be pretty wealthy by most people's standards. But again, in terms of billionaires, if you're a Jeff Bezos or an Elon Musk, the first $30 million, or $15 million doesn't take them very far. They're still subject to billions of dollars of estate tax. We still have that estate tax provision.
And we should also say that once that inheritance is given, whatever money that estate is earning is taxable.
Yeah. And I think part of the spirit of why people are willing to keep this high is if you make money, you earn income, you pay tax on it. If the money you save and invest grows and you sell those assets for a profit, you pay tax on it. So we don't need to tax it again when you die. That's sort of, philosophically, that's the approach that people take, and why some people are comfortable with a limit that's as high as this, saying, okay, we'll let a fair amount transfer since it's already money that's been taxed.
Yeah.
And I would note things like a retirement account, like an IRA, 401k. You still have to pay income tax as an inheritor of those accounts. So some estates that may pass over that have, $5 million, $10 million, you're still going to pay income tax when those assets pass on and are then realized by the inheritors, the beneficiaries. So there's still ways that people within that 15 million will see tax.
As part of investment planning, do you put together these kinds of plans so that you can plan how you're going to give money to your children and pass it down to your grandchildren, and that's all part of the whole financial plan?
Exactly. What we try to explain to people is when they die, when they pass, we have to say when they graduate, their assets will go one of three places. It'll go to people they care about, the government, or charity. And you can kind of move the pieces around to try to limit the amount that goes to the government by maybe giving more to charity and changing the amount with the children. We had a great family meeting just last Saturday where we had two generations of the family there, and the parents got to express their values and their desires. And in that estate plan, for example, all those IRA assets that family has will go to charities because charities will not pay income tax on those assets. The more tax-efficient assets will go to the children, okay? And by giving those dollars to charity, not only do they keep them away from any income tax, but that money is not included in their estate and keeps them below these $15 and $30 million thresholds we've discussed. So intentional asset location and where it goes when you die can help a lot with efficient transfer of an estate.
And that's amazing. You also make provisions for people that are concerned about how their loved ones might spend the inheritance, and there's ways to protect them from themselves, so to speak.
Exactly, yeah. So good trust planning, things like that for heirs that might have a history of substance abuse or just poor money decisions. And I'm always amazed actually how many people will pass lump sums of funds to the next generation, to kids that they know are not good money managers, just because it just seems like the default. Or maybe you have two kids and you give one of them all the money because they're responsible. So I don't want to tell the other one he can't have his money if his brother or sister got their money. So there's all these conversations that get in there. It's not just about taxes. It's about passing along values, passing along good principles for money management to help them be successful so that all this money you've
But you're
managed
also
doesn't get
helping
squandered.
families stay together. Brian, I've been an executor of a couple of estates and, not involved in the planning at all, but just friends have said, hey, can you help if I pass?
Sure.
And I did. And I've seen families split up over $1,000.
Oh, it's amazing. Yeah. So that's why we hold those family meetings like the one I mentioned from last week, was just to create transparency and conversations so that, the parents can sort of guide those conversations and explain why they're doing things the way they're doing them. And bless you for being an executor. I like to say that's the second most thankless role behind HOA president.
It is hard.
No one really says thank you at the end. They just complain about the way it goes typically. So
Yeah. Isn't that true? Give us a few example scenarios after talking about all of this.
Yeah. Yeah, so I mentioned that we use some great tax planning software. I was really impressed. They were following the tax bill as it was being formed and discussed and manipulated so that when the One Big Beautiful Bill passed, day one, we were ready to start seeing, okay, what does this mean for the families we serve? And I started to run some examples, and I think these examples will help illustrate what I explained before, that a lot of these benefits fall more for the middle class and not for those high-income households. So let's start with a couple. We'll talk about two married couples. The first one's more, I guess you'd call upper middle class, two working spouses. Well, actually, one right now. The second one's finishing an education where she'll get to work, but they make about $142,000 of income, so a good income. Nowadays, with cost of living, that's not wealthy. You know, there was a time in my life where $142,000 meant you were living well. But they have 3 kids, wonderful family. And when we ran their scenario that we projected for 2025 based on the current tax or the previous tax law and now the One Big Beautiful Bill Act tax law, they saved about $930 of federal income tax thanks to these new provisions. That was about a 10% reduction in their tax liability. I would note it's actually going to be more than that because they'll probably buy a new vehicle and they may use debt to purchase that vehicle, so they're going to get some of that deduction for the car loan interest. So what benefited from them was the increased child tax credit. So those 3 kids, they get an extra $200 per child under the new law. That was helpful. And then the fact that the standard deduction was maintained at a high level and actually inched up a little bit helped them. Now, if you compare that to another married couple we serve, I mentioned them before, they make about $800,000
That's a lot of money.
in wages. Yep. So they're both working. So this is not a lot of investment income. This is earnings. They have 4 kids in the household. It's a blended family, 4 kids from prior marriages, really wonderful family. They pay about, under the old tax code, they paid about $216,000 federal tax. Okay, so let that sink in. That's a big number.
That is
on their $800,000 plus income. They saved $555 under the new tax code. Mm-hmm. So the first couple that made $142,000, their tax burden was reduced by 10%. The high income household, their tax was reduced by 0.2%. Okay. So the reason for that is all the deductions that could have helped them phased out. They would have benefited from a higher state and local tax deduction if not for the phase out. That was a big one for them. They phase out of the child tax credit, so they don't get the extra $200 for each of the 4 kids in the household. So this is a good example where that high-income household, they're going to save $500 out of over $200,000 of tax paid. So a little bit of benefit there, but not a huge benefit on a relative basis.
Yeah.
Okay. We also work with a lot of retirees, so I like to run examples on them. So I ran 2 single women that we serve, ran tax plans for them. The first one, she's more modest income, about $55,000 of income in her retirement. Had a great career, saved well, lives pretty modestly. So she could actually probably have more income than that by taking more from her retirement accounts, but chooses to live a modest lifestyle. She saved about $1,000, $1,050 is what I estimated, which was about 26% of her federal tax liability will be wiped out by the One Big Beautiful Bill Act. So she receives the full $6,000 deduction on her income as a 65-plus woman, and she gets a little bit of her state and local tax because of the way her property taxes and stuff works. She'll get to itemize her deductions now, and that'll help a little bit. So $1,000 of tax savings, a 25% reduction, 26% reduction in her income tax. If you compare it to another single woman we serve, had another great career, great saver, is earning a good pension thanks to work within our education system. She makes $113,000 income, and her tax savings were $980. So she still had pretty good tax savings, but that was about 20% of her income. So she has twice the income, but not twice the deduction. She gets a little bit of that senior deduction because the phase out there starts at $75,000, so she's in the middle of the phase out. And starting next year, she'll save a little bit more because she likes to give to charity but does not itemize her deductions. So she'll get to save $1,000. She'll get a deduction for that charitable gift that she'll make starting next year. So she gives very consistently but not at a deduction level. So again, who gets a better benefit, right now on those levels, it looks more like the middle income people. The last thing I'd say on that is if you look at where all the tax savings go, on the whole, if you look at what would have happened if all the 2017 provisions sunsetted at the end of this year, and then look at the one big beautiful bill, the tax savings are greater for the higher income folks. And the reason for that is because, again, the higher income folks pay more of the tax.
Yes.
So this is a little complex, but if you follow my math here, so the higher income folks pay about 65% of the taxes, let's say, for the top quartile or top 20% of income earners. So if they pay that much of the tax, they should get that much of the benefit, but they don't. So on a proportional basis, the middle class still earns a great benefit from the one big beautiful bill, whereas the higher class or the upper class people, upper middle class to wealthy folks, they're not getting as much bang for their buck on a proportional basis. Because if you're going to, if the motivation is to cut taxes, if someone's not paying taxes, they're not going to get the benefit.
Yes.
Right? So what really works here is the working class folks. There's a ton of other parts of the bill we didn't cover that don't deal with personal income tax. Things like changes to Medicaid qualification and all kinds of provisions for businesses. I'd be happy to talk about that for a minute. But there's a lot there that has other benefits. But when it comes to households, I think it's good to understand what might be relevant for your family.
The best part about what you just said is it gives me an excuse to have you back and talk about businesses.
Yeah.
We talked earlier about your succession books and how to teach people how to transfer a business to another owner or another family member or something like that. So these are all topics, Brian, I'm going to draft you to come over and talk to us again.
Be fun. I always love having a conversation with you.
I appreciate you.
Yeah.
Brian Cochran is a certified financial planner and the president of John Moore Associates. You can reach out to them at 505-881-5100, or you can reach them at info@johnmoore.com. Don't forget, johnmoore.com, Brian intentionally on the Insights tab presents all kinds of great financial investment advice, webinars, interviews, all kinds of things that you do. I really appreciate you. Thank you for joining us.
Yeah, and I'd note the webinars, we always like to invite guest speakers, so we get the experts on different topics. So it's not just the knowledge of our team that we share. We try to bring in folks that we trust and know certain topics really well, whether it's student loan debt or we're about to do one on Medicare supplement insurance, just trying to keep that information available from the best people we know. So please, we try to aggregate that all there and hope you enjoy it.
I love it. Thank you so much, Brian.
Yeah, my pleasure.